Hello everyone, welcome to Campus View. We are a macro coffee shop on campus. Today we will use real business mini store to show our assets, liabilities, owner equity, and three important accounting principles: revenue recognition, the matching principle, and produce conservation.
Welcome to our demonstration.
Is our first asset, cash. These are our inventory items, for example, coffee beans, milk, and cups. This is rent prepaid. This is rent prepaid, meaning we have paid some of our shop rent in advance. This is rent receivable, for example, orders from campus groups that haven't paid yet. Finally, equipment, our coffee machines and some furniture, which are non-current assets.
I am now injecting 10,000 ringgit as a starting capital into the shop.
We debit cash 10,000 ringgit and credit owner's capital 10,000 ringgit.
Next, we use 3,000 ringgit of the cash to buy a coffee machine.
We debit equipment 3,000 ringgit and credit cash 3,000 ringgit. This is our equipment, our coffee machine, and some furniture, which are our non-current assets.
The coffee machine is set up. We can start serving.
We received a batch of coffee beans from our supplier of 1,200 ringgit, but we haven't paid yet. So this creates an account of payables.
Goods arrived, inventory increased, but payment is pending.
Inventory 1,200 and credit account payable 1,200.
Remember to record the supplier terms so we can reconcile at the month end.
Hi, how much for a copy of latte?
A copy is 20 ringgit. Would you like sugar or milk added?
Yeah, I will have a coffee.
Okay, one latte, 20 ringgit. Cash or scan? Cash.
Yeah.
Okay, thank you. Okay, here is your coffee.
Thanks.
We recognize the sales revenue and match the related cost. Entries are debit, cash 20 ringgit, credit, sales revenue 20 ringgit. Also debit the cost of goods sold 8 ringgit, credit inventory 8 ringgit.
So when we sell 20 ringgit coffee, we also move 8 ringgit of inventory to cost.
Next task, I will come again. I'd like a 50 ringgit gift card of friend.
Okay, sure. And here's your gift cards, value 50 ringgit. Your friend can redeem it for coffee or other items.
Note the revenue recognition principle. When a customer buys a gift card, we receive cash. But when we cannot recognize revenue yet, the entry is debit cash 50 ringgit and credit unearned revenue 50 ringgit. When the gift card is used later, we then move the unearned revenue to sales revenue.
This app has my cash received with the time. We actually provide goods and services, so we don't count revenue too early.
Boss, I found the coffee machine is broken. They are unusable. I estimate a loss of 200 ringgit.
So What should we do about that?
Under the prudent concept, we should recognize this loss as soon as we are reasonably certain. This means that we move the unsaleable inventory from assets and record an expense. So the entry, we debit the inventory, written off expense 200 ringgits and credit inventory 200 ringgits.
Understood. I will record it in the inventory log and dispose of the broken machine.
Recognizing the loss reduces profit now, but it gives a more accurate picture of the finance. Today we demonstrate on an investment, buying equipment, purchasing on credit, a cash sale, gift card payment, and inventory write-off. Each business action had a corresponding accounting treatment.
Key points: revenue recognition depends on whether the service or good is delivered. The matching principle pairs income and with related costs. Prudence concept requires recognition probable losses early.
From the barista side, remember the reconcile cash daily and keep gift card record safe. I'm responsible for filming and editing. I will add the on-screen entries and subtitles so the grades can follow easily.
The coffee is great. I will recommend the copper break to my classmates.
Keep invoices and record everything in the ledger. So month-end reconciliation is straightforward.